Every time you see a headline about the Fed printing money, the real story isn't a printing press at all. It's a tool invented in 2008 that quietly rewired the entire global economy. It's called quantitative easing, and before the financial crisis, almost nobody had heard of it. Here's what actually happens. When interest rates are already near zero and the economy is still struggling, central banks can't cut rates any further. So instead, they do something stranger. They create digital money and use it to buy government bonds, sometimes even company shares, in massive, pre-announced amounts. The goal isn't to put cash in your pocket. It's to push down long-term borrowing costs and force investors into riskier assets, hoping that lifts everything else. But here's the part the headlines skip. This policy wasn't even called quantitative easing when it first appeared. In Japan, back in 2001, the Bank of Japan was the first to try it, but they didn't use that term. It was only in 2008, when the Federal Reserve faced a collapsing economy with rates already at zero, that the name quantitative easing entered the mainstream vocabulary. A Bank of England official later admitted in 2018 that the policy had existed under a different name. We just gave it a new one. The 2008 emergency tool was supposed to be temporary. Today, it's a permanent fixture of how central banks operate. The next time you see Fed announces QE, you'll know the history. A crisis-born experiment that outlived the crisis. That's the story behind the headline.